How high can the price of gold go? The precious metal is being sold for a record $2,000 an ounce. What's driving the gold rush? And could it affect the chances of economic recovery from the coronavirus pandemic? This is Inside Story. Hello and welcome to the programme. I'm Imran Khan. The coronavirus pandemic means we are facing our worst ever recession. Shutdowns to control the spread of the virus have forced many businesses to close. Millions are jobless. And when times are tough, investors tend to put their money into so-called safe haven assets such as gold. Precious metal hit a record high of $2,060 an ounce a couple of weeks ago. That's a 30% rise this year. Now, some analysts are predicting prices to soar to $3,000 an ounce by next year. The price rise is particularly being felt by Indians. They're the second largest buyers of gold in the world for weddings and special occasions.
Business all over India is impacted, not only jewelry, every business except the pharma business. Everything is down, and jewelry business is absolutely around 80 to 90% down because the people are not coming out of the store at their homes. So people are not buying, people don't have cash.
We're purchasing less jewellery than we used to buy earlier. We will have to purchase one necklace instead of two, and we also have to lower our budget for purchasing a gold chain.
There are very few customers buying gold because everybody is focusing on survival rather than buying gold or luxury items because of the coronavirus pandemic. Everybody is trying to save their lives. Most are thinking about how to survive.
Let's bring in our panel. In New York, Christian Lawrence, Senior Market Strategist at Rabobank. In London, Michael Hewson, Chief Market Analyst at the financial firm CMC Markets. And from New Delhi, Arun Kumar, Professor of Economics at the Institute of Social Sciences. Welcome to you all. I'd like to begin in London with you, Michael Hewson. I don't own any gold. Why should I care about the price of gold? What does it mean for me and the dollar, the pound, the ruble in my pocket?
Well, I think what the rise in the gold price tells me is there's an awful lot of people out there concerned, I think, around about the financial degradation, if you like, of assets, fiat currencies, stocks, as a result of the large-scale fiscal and monetary stimulus that's being implemented not only by central banks, but also by governments around the world in response to this coronavirus pandemic. And there's also the added factor that the Trump administration is weaponizing the dollar in its dealings with overseas counterparties, say, for example, like China and Russia. Now, the thing with gold is you can't monetize it. And when you've got people like Warren Buffett turning decades of thinking on its head and going from saying that gold has no useful utility to buying a 1.2% stake in Barrick Gold, one of the biggest gold miners, that suggests to you that an awful lot of people's thinking around gold and its value is changing in the face of this pandemic, but also as a result of the monetary stimulus that's being unleashed and fiscal stimulus being unleashed around the world.
In New York, Christian Lawrence, is this a matter of something that's been developing over a long time, or is it really being driven by the coronavirus pandemic? Are we seeing something new here, or is this something that's been bubbling up for a long time?
Well, I think at the basic level, it's really been bubbling up since the global financial crisis, because, of course, that's when we started to see central banks expand their balance sheet, conducted quantitative easing. And really, this is a story of, it's a tale of two stories. There's the negative real interest rate story, and there is the general debasement of fiat currency because of central bank balance sheet expansion. What's happened during the COVID-19 crisis is, of course, we've seen central banks expand their balance sheet at a very, very rapid pace. I mean, the Fed has expanded its balance sheet 67% since March. So this is about the general debasement of all fiat currencies. So it was happening beforehand, but it's certainly accelerated dramatically because of the pandemic and because of the actions from central banks and governments.
Arun, Kumar in New Delhi. India traditionally has valued gold for a very, very long time. You're looking quite smart right now, aren't you? Your reserves of gold seem to be quite huge.
Yes. Gold is one of the assets in the portfolio of assets that people hold. And when there is uncertainty, people shift towards gold. So the pandemic has created a huge uncertainty. And that's why people are shifting towards gold. The second thing is that, there are cultural values associated with gold. So in India and China, people hold large amount of gold because of, reasons of wedding and, so on and so forth. But also, let me say, the gold price in India is determined by the international price because India hardly produces any gold. And I think what's happened is that the demand has shot up, but the supply of gold is limited because it's mined only in a few countries, South Africa, Australia, Russia, etc. So there's a shortfall in the supply of gold, but the demand is shot up as a result of people shifting towards buying gold. And that's why the prices of gold have risen. But I'd also like to add that gold is an unproductive asset. It doesn't lead to further production. If you'd invested your money in, say, some factory or something, it would produce something. But if you invest your money in gold, then it doesn't give you. But the advantage that gold has over paper is that it's a commodity money. So commodity money always will carry some value. So even if the rupee depreciates, gold would not depreciate at that point of time. So very often it's seen that when, other asset prices decline, like share prices and real estate prices, then people shift into gold as a hedge, as a means of, maintaining value of their assets.
But Arun, Kumar, the only reason gold has any value is because we give it value. We like the idea of it, so we value it at that price. I mean, as you say, it's an unproductive asset. But why is this seen as such a safe bet in times of uncertainty?
So you see, there is always a short supply because, other assets are huge. If you're shifting only a small part of the, from some assets into gold, then there's a shortfall in the, demand supply, and therefore, the price of gold go up. So it's a pretty safe bet in a sense. If you go, according to World Gold Council over the last 40 years, then gold has given 14% return, which is a pretty good return compared to many other assets, and especially, in short-term speculation, if the stock market is going down, you shift into gold and then you can, liquidate and shift it back. It's very liquid, so you can always easily get out, which is not the case with real estate. So there are many advantages. Small quantities of gold will have high value because cost of production is very high. So therefore the value is not just because of speculation, but value is also because of the cost is quite high for producing the gold. So it is an inherent value in gold, which enables it to become a very safe speculative bet in times of uncertainty.
But Michael Hewson in London is a safe speculative bet right now, but it's only because, as I say, we give it value ourselves. It doesn't actually do anything. It doesn't actually make any money. So Michael, is this a safe bet long term, or are we looking at a bubble like, bulbs in Holland?
Listen, there's no such thing as a safe bet. If you look at what gold has done over the last decade, for example, it hit all-time highs in 2011, around about 1921, $1,921 an ounce. It almost halved in value to lows in November 2015. And since then, it's pretty much doubled in price. So it's not one of those assets that essentially, if you hold it for 20 or 30 years, it's going to generate a return. It's like any other asset. You dip in and out of it when circumstances dictate. One of the main criticisms that I've heard about gold is that in real terms, and as an inflation hedge, it is actually lower than its 1980s highs. But ultimately, no one holds a single asset, a stock, a commodity, or anything else for 20 to 30 years. You rotate into and out of various assets over the lifetime so that you generate a return, a consistent return over a time frame. So while no one is suggesting for the moment that gold is probably going to be worth in 10 or 15 years' time an awful lot more than it is now, for the time being, it is very, very wise at a time of negative interest rates to have some exposure in gold, simply because of the gains that we've seen over the course of the past 5 years. Now, it's going to be a choppy ride in the interim, but I would certainly argue with a certain degree of confidence that 5 or 10 years from now, gold prices are probably going to be worth a lot more than they are right now. You can make the same argument about utility, the useful utility of a company like Uber. It doesn't generate any revenues in terms of profits, and yet the market assigns it a very high valuation relative to the amount of money it actually loses. So it's really about funneling money into areas of your portfolio which will generate the greatest return.
Christian Lawrence in New York, are we at a stage where capitalism has gone slightly bonkers and we are assigning value to things like Uber that doesn't make any money, to assigning value to things like gold because we're a bit nervous about what the markets might do? Surely it's better for federal banks, central reserve banks, governments to put their money into production, into making things, into job creation, rather than these short-term bets which seem to be driving up the price of gold.
Well, you certainly make a very valid point there, and I would argue that we don't have free market capitalism at the moment when central banks are essentially backstopping financial markets. Shareholders are backstopped at the moment because of the actions of central banks. Now, gold has a long history of being a form of money, thousands of years. That's why it is still viewed as such. If you take a dollar, we view the dollar as money because we have faith in the US government. We view gold as money because it's a historical factor that's been around for thousands and thousands of years. But you're quite right. What we've seen, particularly in the last decade, but really since the 1980s, is that we live in a world of financialization. The idea of quantitative easing of cheap money was that companies would invest in real world assets. We'd see productivity growth. We'd see wage growth. We'd see economic growth, and the economy functions well. But instead, companies essentially have used that cheap money to buy back their own shares, to financialize themselves, which has meant that asset prices in the form of, say, equities have continued to march higher. But without productivity growth, we don't see wage growth. And that's one of the reasons why we've seen this huge surge in inequality over the last 10 years, because wages have been pretty stagnant whilst asset prices have continued to rise. And that is a direct result of actions by central banks of putting so much money into the system, providing money for essentially next to nothing, or in some cases, negative.
Arun Kumar in New Delhi, for a rapidly developing economy like India, a powerhouse in the world, is the bet on gold, the traditional bet that you have on gold, actually a help or a hindrance when it comes to developing long-term the economy? I'm just trying to understand what does this benefit an economy like India's or not?
No, it doesn't, because India doesn't produce gold. It entirely imports it, roughly about 800 tons of gold a year for the last many years. This year, the imports have come down because the price has risen substantially. But what it means is that the savings from the economy are leaking out. India, as it is capital short, it needs money for its own development. But when money leaks out, when savings leak out, because you have to buy the gold in dollars, then also affects the balance of payment. At this point, because exports and imports are down, we have a surplus in our balance of payment, but, usually we have a deficit, on the current account. And in 2012-13, we had a huge crisis because of a lot of import of gold was taking place at that time. There was a lot of speculation going on. So in a sense, the more people buy gold, the worse it is for the Indian economy, because it affects investment in the economy, especially the productive investment. And that's what you need, to overcome poverty, to improve development and so on. So it's a very unproductive thing. But what has happened is that in India, there are cultural values, people give a lot of gold at the time of wedding. They want to, hold on to gold, because traditionally that's what they've done. It's been a safe bet for people. It's a hedge against inflation in India, where inflation has been reasonably high over several decades. So, overall, many people who are the wealthy, they prefer to hold gold. Second is that, a certain amount of gold is smuggled in, because people also hold their black incomes in the form of, gold. So they earn black incomes, and then the savings are held in the form of gold. So that also drives the price of gold up, in India. and that's why India, buys 800 to 900 tons of gold from the international market. So for Indian economy, it's not a positive thing, because the black economy also means that policies fail. It also means that your investment is not going to productive areas, because the black economy also drives a lot of unproductive activities. So all told, this huge buying of gold in India is a negative thing for the Indian economy.
In London, Michael Hewson, is there an upside to any of this? Say, for example, people are buying more gold. Is that actually good for anybody other than the people selling gold?
Well, I would argue no, because the symptom or the reason why gold is rising the way that it is because people don't have any confidence in fiat currencies and ultimately politicians. If you look at the problems facing the global economy at this time and pretty much since the financial crisis, what COVID-19 pandemic has done is it's crystallized the problems, the structural problems within the global economy. And what the move into gold prices is telling us, not just against the dollar, we're seeing record highs for gold against pretty much every single currency there is. What it's telling us is that the financial system is in significant difficulties as a result of the large-scale stimulus programs that have been undertaken by central banks and the lack of political will by politicians to address these problems. Ultimately, what's happening at the moment is a sticking plaster on the problems facing the global economy. You've only got to look at the banking systems within Europe in particular, and obviously Warren Buffett has already given his verdict on US banks by rotating capital out of them into gold, to say that he sees significant problems in terms of growth, in terms of return, in terms of the overall economic outlook going forward as a result of the large-scale monetization that we've seen of the financial system over the course of the past 10 years.
Christian Lawrence in New York, is this an indicator that the global markets are about to crash? Are we looking at a 2008 style crash soon?
No, I don't think it indicates that. But I do completely agree with everything that was just said about this essentially being a debasement of fiat currency. We're talking about gold prices going up, but really we could look at it through the other end of the telescope and essentially argue that the value of fiat money has come down, and that's why the price of gold is heading higher. So I think it just reflects this huge amount of liquidity that is being pumped into the system by central banks around the world. The expansion of the balance sheet is not just a Fed story. When we look at the Fed's balance sheet, it's around about 30% of GDP. In Europe, we're talking over 40%. And of course, in Japan, we're talking over 100%. And the reason I mention that is because we could see a lot more in the way of balance sheet expansion in the US and in Europe. And if we do, then that's likely to see gold prices move even higher. Or as I said, the value of fiat money move even lower.
OK, so the value of money is coming down. That I understand. That's fairly simple. But how does this affect me? Should I be worried as somebody who's just somebody who works for a living? Am I going to lose my job at some point because the global economy is going to crash because of some product I don't even own?
Well, gold won't cause the crash. Gold is a reflection of the price of gold is a reflection of these attitudes within the market that we are seeing the shift in the value of money, as it were. But if you're just someone that is just in an income-paying job, you just earn a salary, then yes, things are very difficult at the moment. If you own equities or you own assets, then because of this debasement of fiat currencies, we continue to see them head higher. So essentially, it's asset rich versus income poor. So certainly we're moving into a world where things are going to be very difficult for people who are just earning a salary. Whilst the last 3 months have been fantastic if you own assets. We've seen a significant rebound with US equities looking at all-time highs. So it's very much a question of, we don't see the money from central banks driving consumer price inflation. We haven't for 10 years, but it has driven asset price inflation. The idea that there hasn't been any inflation over the last 10 years isn't correct. There has been, it's just been in the financial markets, and that is likely to continue. I suppose the difference this time around is we are getting more help from the fiscal side, and that does bode a little bit better for the average person on the street. But certainly, these are going to be very testing times for everyone. And even with central banks providing all this stimulus to the economy, there's no guarantee that assets just continue to march higher. The rally that we have seen so far has been quite remarkable.
Michael Hewson in London, how long, where's the crash point here? How long have we got if we don't do anything before gold gets so high and the value of money becomes so low?
Well, Christian made a very fair point when he talked about the Bank of Japan's balance sheet relative to the Federal Reserve and the European Central Bank. Potentially they could expand the size of their balance sheets to the same level of the Bank of Japan, which suggests to me that this could go on for quite some time, another 5 to 10 years at the very least. If I knew the answer to that, Imran, I'd be a very, very rich man and I wouldn't be sitting here right now. I'd be packing my bags and buying myself a little yacht. But ultimately, this status quo as it is cannot continue indefinitely. I've been calling since 2012, when Greece was bailed out, for a denouement in terms of the Eurozone debt crisis. Yet here we are 8 years later, and politicians always do just enough to keep the train on the tracks. But you're right, it can't go on forever. But where the tipping point is, I don't know.
In New Delhi, Arun, Kumar, it's an emerging market. The subcontinent generally, plus China, these are places that are becoming powerhouses of the world. They're plugging into the traditional economies of the world, not doing anything new, they're just plugging into that. Is it time for China, for India, the big powerhouses, to actually say, you know what, there is a better way of doing this and the Western way of doing things has failed?
We don't have that kind of independent economic policy at the moment because the world is globalized. But what I can say is that, due to the pandemic, we are actually headed towards a new normal. We're not going to recover back to where we were in December 2019. The asset base, is expanding, but the resource base of the economy is declining. In the new normal, production structures will change, because of physical distancing. I think the potential output of the economy has declined. And I think that's what the crisis point will be, because, several sectors which are doing well, that's okay, but many sectors are going to do rather poorly and their prices will decline. And that's why the huge uncertainty that has been created. Now, when you look at, say, an economy like India, we are, dominated by services sector, and that services sector is the one that's facing problem because of the pandemic. Manufacturing sector also, certain sectors are facing problem because of the physical distancing. So what I see coming forward is that we will be actually in great difficulty. Our recovery will be much lower than that of, say, Europe or the US, because we have a large unorganized sector and people have migrated back into rural areas. So in many industries which are trying to revive are actually facing problem of shortage of labor, and therefore they're not able to revive, and the repeated lockdowns that are taking place in India. And as a result of that, again, the economy is suffering. So we had a bit of a pickup in June, but then July and August have been a bit of a down. So this uncertainty that's there, that's what is driving the problem in India. And that's why, the stock markets have risen very narrowly in the Indian context. And I don't see any new policy emerging from India. China also is facing headwinds because I think supply chains are going to be reoriented. Many countries
Aaron, sorry, we are out of time and I would like to get to my other guests as well. Christian Lawrence, just very quickly, is this still the right way of doing business, the system we have at the moment?
What we have to consider is what was the other approach? Well, I've been quite critical of the impact that very loose monetary policy has. As I mentioned earlier, I can't say that we have free market capitalism anymore, not in its purest sense. But if we hadn't seen these measures from central banks, if we didn't see fiscal stimulus from the government, quite frankly, we would have seen a financial market and an economic crash like we'd never seen before. So it's very easy to poke holes at the current system, and without a doubt, it is flawed. And we will see more in the way of structural issues arise further down the line because of what's happened this year. But the alternative would have been disastrous as well. So it's easy to criticise. It's hard to think of a better solution.
Michael Hewson in London, I'm going to ask you the same question, but just quickly, is this the right way of doing business?
In the short term, yes. But I think longer term, politicians need to perform the act of trying to perform open heart surgery on an economy that's still working. I mean, your previous guest made a very good point about deglobalization. And I think politicians, particularly here in the UK, need to try and construct the narrative that basically shortens supply chains and then shifts the investment criteria into much more renewable and localized industries to try and basically shrink the disparity between the regions, particularly in the UK, where there are large disparities between the lower end of the economic income scale and the higher end of the economic income scale. So for me, it's not about the next 6 months, it's about the next 5 to 10 years. Whether politicians are allowed to do that is another matter entirely.
I want to thank all our guests, Christian Lawrence, Michael Hewson and Arun Kumar. And thank you too for watching. You can see the programme again anytime by visiting our website, aljazeera.com. And for further discussion, go to our Facebook page. That's facebook.com/AJ Inside Story. And you can also join the conversation on Twitter. We are at AJ Inside Story. From me, Imran Khan, and the whole team here in Doha. Bye for now.